Nageshwaran. Sir. Economic advisors, Srimati Chandni Raina, Sri Anthony Syriac, and Dr. Anuradha Guru. I welcome you all. The format of the press briefing will be, first the Chief Economic Advisor will give a presentation on the key narratives from the Economic Survey 23-24, followed by a question and answer session. Over to you, sir.
Good afternoon, everybody, and thank you for being here. Just a personal declaration. We didn't organize the rain to make it difficult for you to come here, so, but we welcome it, like all of you would, given the temperature we have been facing for the last several weeks. And thank you for being here. This morning, Mint very helpfully reminded me of what I wrote in the interim economic review in January. I had spoken about global factors, the introduction of artificial intelligence, the need to balance energy security and energy transition, and of course the imperatives of employment and skilling. Now this economic survey actually picks up on those themes. And more importantly, it tries to identify the areas and actions that we need to take such that these four important challenges can be addressed as best as possible. In some sense, this survey picks up on the theme that all hands on the table must be there, and no economic approach will be exclusionary or will be excluded. We need manufacturing, we need services, we need agriculture. We need the public and private sectors to act together. We need union and state governments to act together. Because given the way the global conditions are evolving, we don't have the luxury of picking and choosing specific approaches in our path towards Viksit Bharat. And that is the overall theme of the survey itself. First, the global outlook. You can see on the charts here that both merchandise trade volume and the industrial production growth have steadily come down in terms of the averages over the last 20 years or so. Somewhere between 5 and 10%, they have come down to between 0 and 5, and now they are struggling to even stay above the zero line. So in general, global growth and global trade volume growth will be difficult to come by. And therefore, the way we can grow our exports will not be because the trade pie is growing, but because we have to grab market share in terms of competitiveness and quality, etc. And second factor, there is global protectionism and a sense of nationalism just in time giving way to the idea of just in case. Security dominates efficiency. Supply security dominates supply efficiencies. And you can see that in the last 3-4 years, protective actions have actually moved up very, very sharply. Trade protective actions. And the reasons cited are on the right side: competitiveness, climate change mitigation, national security, geopolitical compulsions, concerns, etc. But this is going to be with us for quite some time. So we need to be mindful of that. And then the climate challenge and geopolitical fragmentation. We will be speaking more about the climate challenge later on in the presentation. It is about balancing, as I have written also many times in the last 2 years, it's about balancing economic development and also energy transition. But let's remember, historically, energy transitions have not happened in a single generation. Václav Smil has written a lot about it, and especially with so many countries going at it together. I can have it here. Especially with several countries attempting net zero at the same time and trying to achieve energy transition, it is going to be a major issue in terms of resource availability, etc., etc. And then when it comes to geopolitical fragmentation, we are seeing it every other day as well, And this chart on the right shows you how much the mention of geopolitical fragmentation is happening in corporate earnings releases and announcements and so on and so forth. From a bipolar to unipolar to multipolar world and different blocks emerging, etc. It is something that will be with us for some time. So these are the four headwinds that did not, for example, affect East Asia. Japan, East Asia, or China, when they were making their transition from lower income to higher income countries, they didn't have to face these headwinds. From 1979 to 2015, China, for example, did not have to worry so much about geopolitical fragmentation, climate challenge, and global trade. Globalization was at its peak. So we have to now chart our path to Viksit Bharat amidst these headwinds. That is why domestic growth becomes very, very important. Now we first quickly go through the state of the economy, where we are, which is covered in Chapter 1 of the Economic Survey. There is momentum in the economy. In fact, we are now 1 quarter in the new financial year, and even high-frequency indicators are telling us that the economy is carrying on the momentum that we have seen until the end of March 2024, when we grew at 8.2%. So the average growth rate in the last 3 years up to March 24 has been around 8%. And as we write in the survey, real GDP is 20% above the pre-pandemic levels. And the growth has been contributed to by a steady maintenance of the share of private consumption. Capital formation is beginning to recover as we would expect post-COVID and post-balance sheet repair. And exports are doing quite well under the circumstances as well. Of course, some of you might say this adds up to more than 100, but that is to remind you of the fact that it is not subtracting imports here. So otherwise, this is not net, it is not net exports, it's only exports, so it's a gross number. And investment is being driven by not only by public sector capital formation. Both union and state governments have clearly been spearheading the capital formation. But let me also tell you that private capex has been growing. Private capex has recovered. After the stagnation or decline we saw in 1920 and 2021, they did pick up in 21-22 and 22-23. Of course, some of you might go into the granular details available and say that private capex formation picked up strongly in the dwellings aspect and not in the machinery and equipment and intellectual property products, but even that post-COVID. So because if you look at the national income data, you can see the breakdown of private capital formation into these three components: dwellings, machinery and equipment, IP products, etc., intellectual property products. The recovery is beginning to come through in the latter two areas also, which is what exactly will be driving higher quality jobs. And household savings in physical assets has improved, and we have written enough about it. Households are not in distress. Households actually are investing in financial assets, which have done very well. Especially in the last 4 years, the foray of retail investors into stock markets through systematic investment plans, through mutual fund investments, has been quite prolifically documented. And our national income data do not record these at market prices. And that is the reason why there is a feeling that financial liabilities have grown faster than financial assets of households. But financial assets of households are not marked to market. So households are doing quite well in the aggregate. And if you also see the default statistics of small ticket loans, etc., they do not flag any signs of distress, and I have also written about them in occasional columns, etc. When it comes to the agricultural sector, which is the topic of a usual special chapter, and also a box item in the economic survey in Chapter 5, of course, the food grain production in crores of tons, 329 million tons, slight decline compared to the previous year because of the erratic monsoon. And also, let me tell you that this year, we will see a chart later, the monsoon is not exactly proceeding as the IMD told us before the monsoon season began. And while MSPs have been ensuring remunerative prices, we also need to encourage crop diversification with our MSP policies going forward, and that is why I would like to draw your attention to the box item in Chapter 5 as well. Industrial production, you can see a broad-based acceleration in all possible areas for the FY24, 9.5%, recovering very smartly from the overall growth of 2.1 in FY23. And the PLI schemes so far have garnered 1.28 lakh crores of investment, exports boosted by 4 lakh crores, employment generation of over 8.5 lakhs. So in that sense, the PLI schemes is actually gathering momentum, and the results are evident in several product areas such as electronics, pharma, etc. The PLI scheme is beginning to deliver very handsomely on key areas. The logistics performance is also contributing to the export resilience. Some of us might be wondering, what is the export resilience when the merchandise trade value growth appear to have declined in FY24? But you take away the petroleum products and gems and jewelry exports, even merchandise exports actually went up by little under 2% in FY24, apart from services growth. Whether it is the highway construction or in terms of the introduction of new trains and the waiting times in toll plazas, and the number of airports doubling in the last 8-9 years compared to how much we had in the previous 67 years since independence. Container turnaround time at Indian ports, in fact, the seaport statistic, which is covered in the external sector chapter and the services sector chapter, we do talk about the fact that the seaport turnaround time in India is even doing better than some East Asian ports as well. And the pace of railway electrification has also been quite strong. So there is clearly a cumulative and the lagged effect of logistics infrastructure contributing to export resilience and also overall economic efficiency and the relief of supply side constraints. Services export growth, the story of the global capability centers is very well documented, but this captures all of them in one place. India in general is ranked 8th in the business services exports, and 2nd in world telecommunication, computer and information services exports. And overall, India has a 4.3% share. In terms of the share of global value chain related trade, India's GVC contribution has gone up by more than 12.5 percentage points in the last 20 odd years. And the remarkable growth of the global capability centers, starting from the number of centers rising threefold, and in terms of the installed GCC talent, in terms of number of employees, going from 400 to 3,400 in terms of the number of GCC centers operating in India. So clearly, this is one area which might be not only somewhat immune to the introduction of technology, but may actually benefit from it. Coming back to the macro parameters, external debt ratio is much lower than many other countries. In fact, we have a very interesting box item on whether a strong or a weaker rupee is in the overall interest of balance of payments of India, taking both the trade and the capital flows together. From a BOP perspective, what kind of currency stance will be of help to India? It's an empirical exercise. It doesn't have any ideological preference on our part. We simply have recorded what the data tell us. It's very interesting, given that India has a very low external debt ratio. A weak currency doesn't hurt. If India had a very large dollar exposure, a weak currency will be problematic, because what you gain on the trade side, you might lose on the external liability side. But that is not the case with India. You may want to check out that box item. And exchange rate volatility is one of the lowest in emerging market space. And the current account, while it was a surplus in the fourth quarter, overall for the year, it's about 0.7% of GDP. Last time when I stood in front of you in January 2023, we had just completed 1 year of recovery post-COVID. Now we are into our 4th year. And the main theme of the last full economic survey was how the medium-term growth is going to be supported by a much improved corporate and financial sector balance sheet. And that is what we are seeing today in terms of the non-food, non-personal loan growth running at more than 15%. and NPA ratios declining to 2.8%, etc. As long as we can keep the financial cycle going for a longer period, we can be reasonably assured of a baseline growth of at least 6.5%. Inflationary pressures under control. In the previous 3 years, the deviation of inflation from the target of 4% is the lowest in India, and the headline inflation rate is coming well within the band and should come to below 5% in the current financial year. And of course, you all know that the core inflation is running well below 4%. Monetary policy transmission is evident, and monetary policy stance may not necessarily be considered restrictive given the fact that credit growth is running in double digits as well. And both a slew of administrative measures and monetary policy combined to make sure that inflation never got out of hand. And compared to many other nations, the fact that we had a very small deviation from our target was facilitated by the proactive both fiscal and non-fiscal administrative measures and monetary policy measures taken. The continued improvement in the quality of government expenditure at the union government side is continuing from 88 and 12% ratio between revenue and capital. We are now between 79 and 21. So in some sense, you can see here that the decomposition of the fiscal deficit shows that capital outlay has been consistently increasing. And this is the World Bank recently has a development update which is probably on its way, and they talk about the fact that India's public sector capital formation is actually crowding in the private sector capital formation. Now, ultimately, all these macroeconomic statistics have to result in the most important variable that the public is looking for, are Indian formal sector creating enough jobs. If you look at it, based on the returns filed by Indian factories, about 2 lakh of them, in the annual survey of industries, factories which are more than 100 workers, they constitute roughly about 21% of the total number of 2 lakh factories. But they constitute 80% of the workforce. Therefore, it is heartening to see that the workforce growth rate in these factories, which have more than 100 workers, is 13.2% in the last 4 years, compared to the growth rate of only 4.8% in relatively smaller factories. So on top of a larger base of workers in the aggregate, factories with more than 100 workers are actually seeing their workforce rise faster as well. And that is a very good sign of formalization of the Indian manufacturing sector. And this is from the ASI data, which is available until 21-22. This is as far as the current state of affairs goes. Coming back to what I said at the very beginning, we are facing a very challenging global environment combined with climate change narrative and the change, and therefore we need to make sure that we pursue all possible approaches without any doctrinaire orientation or ideological orientation. If anything, pragmatism has to be the policy mantra. And second, in terms of the kind of reforms that we need to do, it is no longer about the big-ticket reforms that dominate your front pages, but more about the grunt work. It's about the nuts and bolts of governance. It's about the plumbing of governance that we need to get right in order to be able to drive growth forward. And that is the theme of Chapter 5 of the Economic Survey. What are the ways, what are the sectors, and what are the ways in which we can ensure that growth continues at a pace by which we can have a fair shot at our aspiration of Viksit Bharat by 2047. It is about generating productive employment. We have a few ideas, addressing the skill gap challenge. And by the way, agriculture can be a very important engine of growth. And easing regulatory requirements and financial bottlenecks for MSMEs, managing the green transition in such a way that we don't jeopardize energy security in the name of energy transition, and becoming a manufacturing powerhouse also requires us to get the China balance right. And deepening the corporate bond market means that India has to ride both the capital market and the banking sector, both the horses we need to be able to provide the kind of financing required to sustain an investment rate of 35% in the economy. And of course, inequality is something that we need to always keep in mind to ensure social stability. And when we talk of productivity and skilling, we all know that economic growth is a function of labor force growth and productivity growth. And productivity growth comes from not only a skilled population, but also a healthy population. And there, the private sector and the public themselves have a very important role to play, more than the government. And that is why, if you have seen the economic survey already, you see that we talk about the compact between governments, private sector, and the public, and the compact between the government, the private sector, and the social sector. That is why we said in the article today in Mint, I wrote that we basically need all hands on the table and all approaches on the table. First, we start with agriculture as an engine of growth. Standard economic theory would tell you that as economies progress from lower middle income to middle and upper income, we vacate the primary sector and we graduate towards high-end manufacturing and then services. But given what I showed you earlier about the way the global trades and the global growth is evolving and the kind of protectionism that is becoming rife, agriculture actually still carries a huge potential for driving growth, if only we can make sure that the incentives are aligned and allied services in agriculture are also encouraged, and land consolidation also happens in a big way. Because more than 85% of the land is only about 2 hectares or less. And this has been coming down. The average land holding size has been coming down since the 1970s. And this is an action area for state governments, because mechanization and technology adoption are not economical under less than 4 hectares. I believe Economic Survey 2007 wrote about it, and that still remains true. And that is also necessary for boosting the average yield in many crops in India, which are at least about 20 to 40% below global levels, whether you talk about tomatoes or onion or cotton or other vegetables, etc. We can do better. And in fact, we are not even comparing the global best in class. Even the average yield, there is a gulf. And if we can bridge this gulf, we not only ensure domestic food security, but also can become a very important global exporter in the food area, which also gives us strategic advantages. And how rising yield, we have given examples of few crops where the rising yield can actually take us how much we can boost production if only we can improve the yield and bring it to the global average. That is shown on the right side. Now, this chart you may have to remember when we come to the end of the presentation as well. This is the monsoon data until about 20th of July from June 1st. This is a 45-degree line, and if you are below the line, basically the rainfall is on the deficient side. Some of the key areas which are very important for grain production are actually receiving deficient rainfall. If you look at the IMD website, you see Southern Peninsula is very large surplus of about 26%. And northern plains about -12, and also eastern and northeast about -14. So you see that the spatial distribution, and we have been writing about it in the monthly economic review, that we need temporally and spatially well-distributed rainfall season. If that is not the case, then there will be question marks on the agricultural yield, etc. And that is why you will see this reflected in our growth outlook down the road. So far we say the monsoon season, barring a very few weeks in between, hasn't really lived up to the billing that we were looking for. And talking of agricultural diversification, you can see that livestock, forestry and logging, and fishing and aquaculture have recorded a much higher growth than the traditional crops. So ultimately, like farmers, like everybody else, respond to price signals and other incentives. So if we can make sure that through a combination of policies, that we can actually incentivize them taking up other areas of allied agricultural activities, moving away from grains, we will make our farming both remunerative, climate friendly, and also water friendly. So this is the framework. This is covered in detail in box 5, in a box in chapter 5. I would urge you to go through that for more detailed elaboration of each and every one of these 5 aspects, which would help make sure that Indian farming sector becomes an engine of growth. Moving on to manufacturing and SME, that is another sector where we need to focus. How do we create an SME space, Mittelstand in German as they call it? Most important thing we can do from the government perspective is deregulation. Threshold-based incentives must have sunset clauses, but more importantly, much of the action is required at the state government level and local government level as well, which is where much of licensing, inspection, and compliance, the LIC acronym, is very important to loosen the grip in the local government level. And then when it comes to skilling, most of our entrepreneurs are very instinctively entrepreneurial, understand their business and customers very well. Where they need trainings with respect to financial management, working capital, inventory management, etc. So targeted interventions will have a big bang for the buck in terms of boosting their productivity. Other important aspect of the LIC being loosened is that most of the small enterprises have very limited management bandwidth. So if we can kind of reduce the compliance burden on them, we also release the bandwidth for them to focus on growing their business and also focusing on their human resource endowment as well. And that is what will make India's lopsided distribution of enterprises. Too many micro, some large, but a huge gap in the middle that needs to be plugged for us to raise the manufacturing share of GDP and the manufacturing employment share as well. Financial access usually is considered a very big roadblock for MSME growth. We have done quite well in that regard, both during COVID and afterwards, by providing the guarantees. The number of CGT MSE guarantees invoked and the amount used up are quite good. Without this intervention, the micro and small enterprise sector would have faced even more difficulty. So this has really worked in preserving the health of the MSME space. And then the startup ecosystem, from over 13,000 DPI recognized startups are there, and the number of patents filed per year, it is not a typo, it's real, has gone up by 17x between FY15 and FY24, 17 times in the course of 9 years. So startups usually begin with not micro space, but small and medium space. So we are definitely paying attention to the financing and the ecosystem aspects of nurturing SMEs. And we are also beginning to realize the potential of the digital public infrastructure in making sure that our micro, small, and medium enterprises have global access through the digital network. They don't need a physical presence. The open network digital commerce, I remember writing about it with Mr. Nilekani about 2 years ago. It has a very big potential to make our even small enterprises global players. And you can see the statistics here in terms of the number of cities being covered, number of transactions happening. Most of them are small sellers, etc. So this is definitely has a huge potential in realizing our MSME aspirations as well. But above all, what we need to focus on is the deregulation aspect. And I can't go into the full details of all the rules and regulations and laws that need to be loosened. We are only giving you a couple of examples. For example, the amount of space Indian laws mandate that per worker is 3.4 square meters, and even Southeast Asian countries, advanced economies, have a much lower requirement. On the left side, you can see the amount of land we need to allocate for setbacks on all 4 sides, the parking space, and the floor space index is much lower in India. And these are all state government regulations, not union government. And even if majority of the Indian states move towards the best Indian state, which on the basis of a study happens to be Haryana, if they move to Haryana level, the amount of land we free up for our businesses to utilize for actual manufacturing goes up. So per unit fixed cost of production will come down dramatically, opening up space for them to hire more workers. So that's why I said the clue to sustaining growth lies in the nuts and bolts of economic deregulation. And second example is the floor area ratio and the car parking spaces compared to, for example, what Singapore or Hong Kong and even the most industrialized states of India have only 1 floor space ratio Haryana is 1.5, Odisha is better, Uttar Pradesh is much lower, and look at the amount of car parking spaces we mandate is much more than what typically Singapore and Hong Kong, which are manufacturing powerhouses, also mandate. They are much more than what they ask for. So in all these senses, it leads to a loss of about 3 lakh crores in terms of for a micro factory, and for a mega factory it's about 3.2, micro is about 2.7 lakhs, etc. So there is a huge sort of low-hanging fruit here in deregulation from the point of view of boosting economic output. The other aspect is also with respect to rising formalization of the workforce. We are seeing that in the EPO4 membership, and we also saw that in the annual survey of industries, factory workers in the larger factories growing much faster. And what is heartening to see is that some of the staffing companies have recorded an average growth rate of 13.2% in the last 10 years, because these workers come with full benefits. ESIC, EPFO, gratuity, work contract, payment of salary through banks, all these things are prevalent in the case of workers hired through the staffing companies as well. And one of the highlights of our chapter on labor and employment, chapter 8, we have done an estimation of what is the amount of jobs we need to create. And you might wonder why we stop at 2036 and not go up to 2047. If you look at the population estimates given by Ministry of Health in July 2020 in a publication which is open access, they project India's population until 2036. So based on those projections, we estimate that India basically needs to create roughly around 8 million jobs or 80 lakh jobs per annum. The calculations and the assumptions are given in the survey as well. In fact, we are making available the spreadsheet as well for replication. And what is heartening with respect to the skilling requirements is that earlier we used to worry a lot about enrollment in higher education. That is no longer the concern in India. The aspirations have shifted. It's about learning outcomes. In rural India in 2000, only 2.4% took to higher education. Now that number is 10.8 in 2022. Only 17.9% took to higher secondary education. Now it is 42.9%. So enrollments have picked up tremendously. On the right side, what you see is that tertiary education was 6.7%. Now it is 28.4%. And what you don't see here, but in the survey, you will see the ratio of women to men in tertiary education used to be 77 to 100. Now it is 96 to 100. So there is no more of a gap between women and men enrolling in higher education, the fruits of which will be evident to us in the coming years. And I talked about two examples of deregulation. This is the third example. Number of activities restricted for women in different states is totaling 139. We just took a sample of about 10 states. This is based on some very good work done by an independent agency. So when we talk of boosting female labor force participation rate, boosting production, etc., again, this is in the realm of state government. Some of these restrictions are preventing women from participating more in the labor market. Skilling, what used to be 33.3%, the proportion of people who take the employability test and pass was only 1/3. Now it is more than 1/2. But still we can say that the journey has been impressive, but the task ahead still is quite large, with little under half still not considered employable based on this national test being administered. But the progress is important to make note of. The other aspect that which I have written about in the preface and also is importantly covered in the chapter on employment and labor. Artificial intelligence, apart from its extremely high energy intensity and requirements, is covered in the discussions on climate chapter and in the special essay in chapter 13. The impact of AI is still not very well understood across the world. While the GCC kind of jobs may not be very easily affected in the near term, some of the business process outsourcing jobs may be affected, which AI can very easily done. Medical transcript reading, image creation, animation, etc., can be easily taken over. So India may have a slight short-term negative impact followed by a medium-term positive impact. Therefore, it is necessary for the Indian corporate sector, both information technology and non-IT sector, to find the right balance between deployment of technology and deployment of labor. Because without labor income, without labor employment, there is no demand growth, which means it comes back to hurt the corporate's top line and bottom line as well. So they need to see this as a win-win. How to make sure that the deployment of technology does not hurt the labor share of income and the capital share of income is a very important medium-term challenge from the corporate's own self-interest perspective. And you can see that corporate profitability has gone up from 5.3 lakh crores in FY20 to 20.6 lakh crores in FY23. That's almost 4 times in a space of 3 years, including financial sector. If I exclude the financial sector, it has gone up from 4.1 lakh crore to 13.9 lakh crores based on a sample of about 30,000 plus companies. On the right side, you see the compensation to employees, which usually is a function of 2 variables. One is the amount of hiring you do and the amount of wage growth you give. And that has not correspondingly grown at the same pace. And by the way, this compensation to employees also includes top management salaries and perks, options, etc. So you can imagine if we have the data on the median worker compensation in terms of hiring, etc. So basically the point is, as they said, the deployment of robots in automobile factories in the US was considered a very important development, but then the robots don't buy the cars that the companies make. Similarly, the artificial intelligence you deploy may not buy the products that you make. So in some sense, as we said again, when it comes to driving growth, it is not just the union government, it is state governments, it is local governments and the private sector finding the right balance between capital and labor. And more importantly, to get the manufacturing right, the China challenge that India has to deal with. In terms of India's trade deficit with China, much of it comes from capital goods products, which means they are important inputs into our production process. And the trade deficit is roughly around $87 billion as of now. And trade diversion by the West away from China can actually cause India to widen the trade deficit. Indian industries will be placed as intermediate suppliers between China and the West, and the drive for enhanced manufacturing capacity within India may also make us more dependent on capital goods, because Chinese capital goods manufacturers have also eliminated competition in Europe elsewhere. So we have no alternative choices to depend on. And in the near term, the negative capacity utilization change, i.e. idle capacity in China on the left, and more strangely or somewhat disappointingly, their willingness to stay in the low-skill manufacturing, low-intensity manufacturing, despite making considerable progress in battery technology, electric vehicles, etc., high labor content, low value added, and low skill manufactured goods, they are still very much present, and they are rising as well, whether it is knitted apparel, footwear, leather, etc. So you take both these things together, this could be one of the risk factors making India's capital formation grow more slowly than otherwise. So given this, if we continue to import goods from China, given that they have excess capacity, and they are also considerably foraying back into low-skill manufacturing, the trade deficit will only continue to widen. Therefore, we need to strike the right balance between import of goods and import of capital, i.e. FDI. This is also a box item in Chapter 5. Brazil and Turkey, for example, they raised barriers to imports of EVs from China, but incentivized FDI from China for EV manufacturing in their countries. So this is the kind of balance we need to figure out as well. Coming to climate change, which is the topic of Chapter 6 and the special essay Chapter 13, look, nobody is in denial, especially those of us living in Delhi can very well understand that climate change is a reality, global warming is a reality, and it is mostly anthropogenic. There is no question about that, since 1980s. But the question is, life is only about trade-offs, whether it is personal decision-making or economic decision-making, it's about trade-offs. We have to recognize that if we go too fast into renewable energy, we become overly dependent on single country for the resources. Technological challenge is still there. There is not enough storage in the world for renewable energy, and you need backup from fossil fuel energy in the night when there is no sun and when the wind doesn't blow. And India is a relatively scarce in usable land, which is required for multiple purposes. And there are fiscal implications in terms of tax revenue foregone and freed revenue foregone from fossil fuel transportation or fossil fuel sale. And what about labor displacement, which is currently employed in the traditional energy sector? And what happens to stranded assets impairing bank balance sheets? And given that we are investing a lot in public mobility as well, we need to strike the right balance between e-mobility, which is personal in nature, and public transportation like metro, rail, etc. So these are the multiple considerations we need to factor in when we pursue our energy transition. And first point I mentioned about resources constraint. The red color is very ubiquitous in this slide, and you can see that the dependence on China for cobalt, lithium, graphite, given their processing capabilities, geographical concentration of refined products, and as well as dominating in the downstream and mainstream EV supply chain. This is a reality. And there's an article in The Economist in May which talks about some solar wafer making equipment being exported to India, being delayed, etc. So between modules, cells, and wafers and polysilicon, we have made some headway in solar module manufacturing, somewhat less so in solar cell manufacturing, but wafer, we are in the early stage. But the wafer making equipments have to come from China. So in that sense, we need to understand all these dimensions as we manage our energy transition as well. And look at the amount of revenue we generate from coal-free transport for the railways, and the amount of tax revenues we collect between center and states by selling petrol and diesel. It's about 7.5 lakh crores every year. So the speed with which we abandon ICE engine-driven vehicles will also impact sale of petrol and diesel, and therefore tax revenue. And on top of it, we subsidize renewable energy. Moving on, in terms of land availability, also apart from when we talk of energy transition, we always focus on new supplies, alternative supplies, wind energy, solar energy, nuclear, etc. But the source of energy demand has to be addressed, and surprisingly in the West, food-feed balance is a very important source of energy demand. And therefore, the amount of land that gets freed up in terms of and India actually is a good example in making sure, as we'll see in the next slide, India actually has a much better balance in terms of food versus feed, in devoting the amount of land we need for feeding the population and feeding animals. So the land that is freed up in having a better diet mix will go towards making land available for renewable energy. You see the chart here. India has a very low share of cereals allocated to animal feed. Animal feed consists of mostly human inedible food, but in the developed world, most of the land is being utilized for generating food which goes to feed either industrial uses or meat production. The important thing here is that if the rest of the world were to follow the same principles as the West, we simply don't have enough land to feed our people, to feed our animal, and to provide for renewable energy, and to provide for industrialization and manufacturing growth. So again, it's a question of finding the right balance. So as I said at the very beginning, policy is no longer about whether we do energy transition. Policy is no longer about whether we grow manufacturing. Policy is no longer about whether we do skilling or employ more women in the workforce. All these things need to be done. But how is the key issue. That is why, as I said, the mantra for reforms is all about grunt work. And that requires a tripartite compact between industry, government, and academia. When I say government, it means governments rather than government in singular, union, state, and local. And as far as the private sector is concerned, on the left, abandoning short-termism, focusing on job creation, investment in R&D because Indian private sector has a very low R&D investment, and carefully deploying capital and energy-intensive technologies. AI actually is highly energy-intensive. And many of the major IT companies in the world are pushing back their net zero commitments because of their AI data center deployment. And also, the private sector has a responsibility to shape the design of higher education. And also, more importantly, when I spoke about the health of the Indian youth, some of the kind of food products that the Indian private sector markets to our youth have a detrimental impact on long-term productivity of our youth as well. So in that sense, these are the areas in which the private sector has to think about its role in Viksit Bharat. On the right side, we have the role of governments, unshackle the private sector, and academia. Because if you look at the new education policy, several elements of it are non-controversial and can easily be implemented, especially exposing higher education to market competition. Introduction of key reforms, which I mentioned where you can find them in the economic survey, and more importantly, displaying an awareness that the global environment is more challenging than what our contemporaries found when they were growing, and encouraging more cooperation, communication, and fostering trust between the government and the private sector. Now, we may have written 476 pages, but you will focus on only one paragraph in Chapter 1, State of the Economy. That's the reality, which is the Chapter 1 and the last para on what is the growth outlook and why, when everybody is saying 7, 7.2, etc., why is this guy saying 6.5 to 7? We are not pessimistic. We are actually very optimistic about growth, but we are also mindful of the challenges which I listed to you, about the way the monsoon has progressed, about how, since we wrote the interim economic survey, so to speak, in January, where we were more confident about 7%. Since then, the global environment has become even more polarized. And financial market valuations are much more elevated. So given that we feel 7% is doable, but yet we want to be not necessarily cautious, but somewhat prudent in projecting, we would rather be very pleasantly surprised than being forced to face disappointments. And that is why we are projecting a growth rate of between 6.5 and 7. And last year when I stood in front of you in January 23, at that time also I was cautious in my growth projection. In fact, I said the downside risks would dominate the upside for FY24, but I was very happy to be proven wrong. Because one thing you can be very certain of is that almost all GDP forecasts, growth forecasts eventually turn out to be wrong. And that is the reality, whether it is the international institutions or individuals or economics division in DEA in Government of India. But we have to give an estimate to give a sense of direction, and we feel that while 7% is eminently doable, there are some risk factors given the way the monsoon has shaped up, and financial market risks are rising in the developed world with the spillover effects on India and also the global geopolitical environment. And these are the risk factors I just now mentioned to you. But one thing we are very clear about, I don't know how many of you have heard of the Stockdale paradox. If you haven't, I encourage you to pick up a copy of Jim Collins' Good to Great and read about the James Stockdale paradox, the American military officer who was captured by the Vietnamese rebels, but who managed to survive his detention in Vietnamese prison and came out alive compared to many of his contemporaries. So that is the Stockdale paradox. And the paradox is that we are upbeat about India's prospects, but we are also aware of the challenges and the external environment and the headwinds that we find ourselves in. If you look at what we have come through, we have come through with a 35 times increase in nominal GDP in rupee terms, from about 6,000 rupees to 2.12 lakhs in the last 30 plus years. In dollar terms, despite rupee depreciating by about 3% every year, we have come from $348 to $2,500. So we have come through different global environments, different domestic environments, different political arrangements, etc., and still the long-term trajectory is very clear. So we can get where we want to get, and we will get there far better if we are aware of the kind of challenges we face, and that is the core message of the economic survey as well. And let's also be very clear that India is extremely unique, and this word unique is cliched, very widely used, but it very well fits India. No country of this size in terms of geographical spread, population size, has managed to attempt the kind of transition or transformation within the democratic framework with 28 states, multiple languages, and a hugely ancient civilization, etc. And the country internally has many different countries within it. So we are attempting a transformation to become a developed nation. Given this kind of context we have, and given the kind of global headwinds that we face, and therefore we remain very upbeat, but we also are aware that we need to basically do the detailed grunt work that will take us from here to there. Because what brought us from $348 to $2,500 in the last 30 years, when the world was very different, will not be the one that will take us from $2,500 to $10,000. And that awareness is what we try to convey in the economic survey. Thank you very much.
Thank you very much, sir. Now it's time for question and answers. I will request you to introduce yourself with organization before asking the question. Number 11, please.
Good afternoon, sir. I'm Ruchi Bhatia from Bloomberg News. You did tell us that the economic survey is more conservative on growth. But in the economic survey fine print, you have said that the private sector investment is still very cautious. What are the key reasons for it? That's number one. And secondly, while you've put out an estimate for 8 million jobs that will be needed in the non-farm sector, if private sector investment continues to be weak, how do you expect these jobs to be created in the economy?
I did not say the private sector investment is weak. On the contrary, my slide showed that private sector capital formation has picked up in the last 3 years. In fact, I specifically mentioned that investment in machinery and equipment and intellectual property products have recovered more in the last 2 years, or in line with the growth in public sector capital formation. I said that private sector it's a risk factor. It is not a baseline scenario. It is a risk factor. That if seeing the excess capacity in China and seeing the way the global environment is evolving, if the private sector were to turn cautious, and by the way, when it turns cautious, it doesn't mean that there is an absolute decline in capital formation, but the growth rate may slow. In fact, one of the slides we showed, the private sector capital formation on the basis of the data available from a small sample of 3,000 plus companies grew by 20% in FY24, 19.8%. Now, in FY25, it grows by 12% or 15%, let's say, for example. You might say that the growth rate has slowed down. We are not saying that the private sector capital formation will not expand. What is the question?
The fact that 8 million jobs need to be created in the non-farm sector. I mean, which are the areas that you're looking at where these kind of jobs will be created? Also, if only 50% of the graduates are employable, how big a risk do you think will it be for the new jobs and, of course, the kind of skill sets that the kids will need to have?
So we mentioned in our survey, the chapter 8 also, all the steps that government is taking towards generation of employment. However, as CA has also in his presentation mentioned, that the private sector needs to do its bit in the middle to get the employment to the level that would be required for the increasing workforce. Also in the chapter you will like to go through, you will see that we have suggested 2 important areas for further taking up, like the care economy and the agro-processing sector as some examples, which anyways government is taking a lot of steps and which with the help of the private sector can further be strengthened. That's all.
Thank you.
One more correction to your point. We said 33% was in 2014. Now it is 51.3% in the employability. No, but given the size, the base, 51.3% is a very substantial number in India. That way, the base effect is actually working in India's favor.
Thank you. 124.
Sir, Timsi Jaipuria from CNBC TV 18. Two key questions here. One on AI. You have said that AI is going to take away a lot of jobs, but the corporate sector or the private sector has to be a little mindful because it is going to impact both their top line and bottom lines if they do not work on the labor force and the employment and the labor force incomes. Apart from that, would you like to elaborate on that? What sort of challenges or threats are you seeing, and what you want the corporate sector to be mindful of in terms of when they work on this? Also, apart from this, you said deregulation of policies. Policies are leading to a lot of burden for the corporate sector and the private sector, and especially SMEs. The burden is increasing, and that is creating a lot of issues. Though that has lightened, is what you said in your preface also, that the burden has lightened over the years, but yes, it is still quite high. So what do you mean about that?
Before I answer both your questions, I want to correct two impressions that came out in your question. I didn't say AI will take away a lot of jobs. I simply don't know. I didn't say that. I said it is possible that jobs related to business process outsourcing in the short run may be under threat, whereas AI might actually turn out to be a job booster in, and a complement to labor in higher skilled jobs. I said the impact of AI on employment across the world is barely understood. So it is very early days to talk about lot of jobs will be lost or too little jobs will be lost. Nobody knows, but we need to be mindful of the possibilities, and we need to make sure that as we deploy AI, we also prepare the population to be able to participate in it by redesigning curriculum, by creating in-house courses, etc., to make them AI employable and AI compatible. So the reference to lots of jobs was not there in my presentation. And secondly, when I talked about deregulation, I didn't say about the private corporate sector. I spoke about the MSME sector much more. The private corporate sector, by all accounts, based on profitability data, is doing very well. And they have one of the lowest tax rates also among the world. So important from the point of view of boosting manufacturing and creating a Mittelstand, the spine or the vertebrae of the economy, which is basically the small and medium enterprises, and that is where deregulation will have a much bigger bang for the buck. And we have given some examples in the presentation and also in the survey. But ultimately, it is an area which predominantly, not fully, predominantly lies with the state governments, and they have to look at their respective statutes, rules, regulations, inspection and compliances to be able to unshackle the productive sectors.
Sir, just a small addition. If you can explain on the household savings, that how household savings are not dipping, but they are actually moving towards higher yielding areas. That's what also you mentioned.
No, I think in the interest of time, we will probably move on to other questions, because I have written about it in an article in Mint, for example, on the 29th of April in great detail.
Sir, I'm Monica from the New Indian Express. Am I audible? Yeah. Sir, most economists, they are of the view that the government needs to revisit the inflation targeting regime, because they think that the 4% target is quite high, and because of that, the borrowing costs are quite high. So, can you please share your thoughts on this?
On the 4%?
Yeah, they think that the 4% target should be increased to 6%, so that the borrowing costs, they come down, and the interest rates become lower and can benefit common people and also investors.
No, it should be the other way around. It should be the other way around, isn't it? Yeah, we actually create even I think we seem to be having some difficulty in understanding the very premise of your question. If the inflation target were to be, say, increased to 6, then the real rate being around 1%, then the nominal rates have to be at 7.
So actually, they say that in a bid to push inflation lower, So they keep the interest rates high. So this is the logic they are giving. And they are also saying that there is a need to consider both WPI and CPI while setting the inflation target. So if you could give some clarity on this.
I think probably this is a question better addressed at a Mint Street press conference in Mumbai.
Thank you. 126 पीछे जाइए. हाँ.
सर मैं लक्ष्मण हूँ CNBC आवाज से. कैपिटल मार्केट को लेके इकोनॉमिक सर्वे में कहा गया है कि द सिग्निफिकेंट इंक्रीज इन रिटेल इन्वेस्टर्स इन द स्टॉक मार्केट कॉल्स फॉर केयरफुल कंसिडरेशन. मेरा क्वेश्चन ये है कि इक्विटी मार्केट के रेगुलेटर या फिर फाइनेंस मिनिस्ट्री से इकोनॉमिक एडवाइजर का क्या सजेशन है, किस तरह का रिकमेंडेशन है इस कैपिटल मार्केट में जो रिटेल इन्वेस्टर्स का पार्टिसिपेशन बढ़ रहा है उसे.
So there is no problem with the participation of retail investors in the capital market. It is a very healthy thing. It has actually created a very good buffer for Indian markets in general, given an additional saving option or additional deployment of savings for our households in the last 4 years. So capital market participation by retail investors is a very healthy and a very welcome thing. The issue is in what kind of capital market participation that they are engaging in. Speculative trading in futures and options is something that I have commented upon earlier, and that's exactly the point that we are driving at, because they are not exactly benefiting either the households or the purpose of capital formation in the overall economy.
71, please.
So Meghna Mittal from Money Control. You said that because in view of the current challenges that are there in the global environment space, lot of heavy lifting will have to be done on the domestic front in terms of growth. But do you also think that especially in agri growth and in the rural consumption, that can pose a significant challenge, especially because the monsoon has also not progressed the way the IMD had predicted?
So what was the question? Was it a statement or a
so
question?
I'm asking that on the because the lot of heavy lifting will have to be done on the domestic front, rural consumption and agri growth, can they pose a significant risk to the global to the domestic front as well?
So the chapter on agriculture and food management, which is I think chapter 6, talks in detail about the measures that have been taken by the government to basically keep the agriculture sector growing. The public investment has increased over time in agriculture, and and you also see substantial subsidies and policies that are generally pushing the farmers, the agriculturalists, to move towards areas that will generate higher incomes, like the animal husbandry or fisheries and other allied sectors. I think in that sense, the government is cognizant that agriculture sector needs to be and is the mainstay of the economy, with the large proportion of the people employed there. And it is taking measures, and therefore the focus is on that across all the subsectors within agriculture. If you look through the chapter, there's a detailed discussion about the policies, about the reason why those policies are being implemented, and their economic rationale. So if you go through it, I urge you to go through it, and you will have your answer. Thank you.
265, please.
Hi, good afternoon, sir. I'm Kriti from Informist Media. So we saw a common thread running through each of the chapter was expansion of data collection and better statistical system. You mentioned that there's a need to update the IIP. There's a need for state variant of similar indices. So what would be the roadmap for that? And is there a timeline for each of these stepping stone for overall system overhaul of the statistical system? And second, just one more question. You mentioned that despite good credit rating, India's sovereign green bonds have not garnered the kind of greenium you would have expected.
So what do you think led to that, and how that could be fixed, and so that it is more attractive for the private players? Thank you.
Sorry. On the first question on the statistical systems, all I can say is that the work is underway on all those aspects, and soon you will see these things becoming a reality in terms of newer indices with newer weights and newer components, etc. That is, work is very much underway at a brisk pace. By the way, the greenium issue is not peculiar to India. The greenium issue is an issue that plagues, and Chandini can correct me if I'm wrong, all green bond issuances across the world. It is not that there is something lacking in India's offering. In fact, we have a very high green rating. And I'll ask Chandini to supplement it. And therefore, it is about the private capital across the world and in India being willing to walk its talk on saying that we are interested in investing in green projects. It is not that India is missing something. Please.